Okay, welcome everybody. Thanks a lot for joining us today. My name is Clay Malcolm here at Advanta IRA, and I'm lucky enough today to be joined by Nathan Turner of Earnest Investing. Nathan, thanks a lot for joining me today. I appreciate it.
Absolutely, my pleasure. Good to be here.
Yeah, and as you guys might have discerned from the title, Nathan's put together an interesting take on note evaluation and how to participate and what things might be important. So I appreciate you taking the time to craft a presentation that might help everybody in terms of their investment strategy. Thanks again.
Yeah, excited to get into it.
Yeah. So from a housekeeping standpoint, for those of you on the broadcast, please do go ahead and anytime you have questions, go ahead and type them into the questions box. We're going to take those at the end. But you might want to type them in as they pop up for you. And then if the presentation covers that topic, then we'll just kind of skip over it. But please do feel free to do that. And I'm going to talk a little bit about self-directed IRAs and the way that they participate with notes. So your self-directed IRA can certainly take advantage of private lending. But Nathan's really going to do the bulk of the presentation today and talk about his experience in that asset class and things for you to kind of take on in your own process. So that's how it's going to go today. And with that, we will go ahead and launch right in. So all the information today is for education purposes only. At Advanta IRA, we do not give tax, legal, or investment advice. We don't advocate any particular investment vendor or investment strategy. And we certainly encourage you anytime that you're vetting a potential investment to use your team, whether that's an attorney, CPA, family members, financial advisor, any of those folks who kind of help you make decisions about your finances. Certainly encourage you to bring those to bear. Sometimes disclaimers are a little bit of a, let's just get through it, but this one in particular does kind of indicate the position that Advanta is in the equation. Our job is really to just document the activity of the account so that your IRA, whether it's a traditional or Roth or one of the other account types, gets to keep its tax advantages while investing in alternatives. So again, no tax, legal, or investment advice. Our job is really to listen to you, what you want to invest in, and document that activity properly so that you get to keep the tax advantages and the account stays in good standing. So that's where we are in the equation. And Advanta was really built for customer service. So we long tenured employees. This is an older slide that says 1.3 billion in assets. I should have changed that. We're actually at over 2 billion now. So we're kind of a medium-sized company in the space, and I think that puts us in a good position because we've seen everything, but we're also small enough that you still get personal attention. So every account holder gets a 2-person team at Advanta. It's myself as a education and onboarding person, and then one of our dedicated account managers will also be part of your team. You have our email, you have our phone numbers, so you know where to go if you ever have questions or if you want to initiate a new transaction or have some activity that you want to do in your account. We want to make it as easy as possible for you. And certainly I've been a self-directed IRA investor and HSA investor for over 10 years. And so I'm acutely aware of the process that we go through when we are establishing a new investment or calculating our return, our ROI, looking at the returns on the online portal, so on and so forth. So, I'm one of us when it comes to being a self-directed IRA investor. And when I'm talking about self-directed IRAs, it is sometimes confusing just because of the way that the term is used. Self-directed is not an account type or a legal distinction. It really is a descriptive term that talks about the fact that the account holder will have some sort of choice in terms of the assets that the account buys, right? So the basic process is you make contributions to a tax advantaged account. That money is going to buy something. Most of us grew up, kind of thinking that was going to be stocks and bonds and mutual funds, which are available. But there's a much bigger variety. And so if your IRA is at a bank or brokerage house, it could still be self-directed, but your choices may be limited because usually if they're the custodian, they'll say, we'll be the custodian for your IRA, but you have to, while your IRA is with us, you can only buy the things that we sell, which is usually publicly traded securities. Advanta took the opposite approach. We don't do publicly traded securities super well. We specialize in alternatives and private assets and hard assets. So you can see a list of those assets that we handle in terms of categories on this slide. So real estate, private lending, which we're going to focus on today, private placements or private equity, precious metals, and cryptocurrency obviously has become much more popular recently. And you know, the IRS is going to let your IRA, your tax advantage money, buy something other than publicly traded securities, and it could be any of these asset classes. The thing that you have to do though is have a custodian that knows how to handle and do the administration for those assets, and that's where Advanta comes in. So again, we've specialized in doing the bookkeeping, the administration for these alternative assets so that they get to produce returns for your IRA. They get to have the tax advantages, but it doesn't have to be a publicly traded security like a stock or a mutual fund or something like that. And one of the big advantages, I think, of self-directed IRAs, especially ones that are invested in alternatives, is that you get to use the team that you already have, that you know and you trust. So your attorney, your CPA, your financial advisor, your family, your note broker, your real estate team, whoever it is that you already deal with and you know and you trust, you can bring those to bear to make money for your IRA. And I often say that if you know how to make money outside your IRA, you can usually use that same strategy or expertise inside your IRA to make money there. You have to take some time to set it up properly, but certainly that expertise that you or your team has can be exploited for the benefit of your retirement account. And I mentioned the fact that self-directed is a descriptive term, and so just to be clear about it, the account types are actually the ones that you already know. So traditional IRA, Roth IRA can invest in these alternative assets or hard assets or private assets, right? Same with all these other account types, right? So a lot of people are unfamiliar with the fact that their health savings account can also invest in these alternatives and be self-directed. If you have a SEP IRA or a simple IRA, those can also be self-directed. Education savings account. We handle solo 401ks for those of you who are self-employed. And I put former employer plans on there, and I'll talk about this a little bit later as well. But the very common scenario for us is that somebody will have an old 401k or other retirement plan, whether it's a 403b, 401a, through a savings plan, whatever it is, and they will see that it's not performing the way they want to, or they'll want to diversify. So they'll open up a traditional or a Roth with us or one of these other account types, and they'll do a rollover, no tax, no penalty, over into that IRA, and they do that so that they can access these alternative assets, right? Your money has to be positioned with a trustee or a custodian that knows how to handle these assets. So they will move the money over to us and then start investing in their chosen asset class. So again, the account types are exactly the same. Contribution rules, distribution rules, tax advantages, all the same. The only thing that's really changing is that money, instead of buying a stock or a mutual fund, is going to buy a piece of real estate, or it's going to make a loan, or buy some cryptocurrency. Again, any of those assets that we talked about. And to focus in a little bit on lending, I'll just highlight a few things about the way that the IRS sees IRA investing in notes. It's unbelievably free of clutter from an IRS perspective, in my opinion. It's really kind of amazing that the IRS will let us use our IRA funds to make money this way. So you can originate the note, or you can buy an existing note, right? And one of my IRAs made a loan to my brother, and so it was helpful for everybody, and it got paid back great. And so, my IRA made some money. He was able to use the money in the way that he needed to. And so I originated that note. There's no collateral. So you can see that second box. The note that you originate or buy can have collateral attached to it or not. The IRS lets you determine that. It also lets you determine all of those terms. So the length, the interest rate, all of the particulars of the note are allowable from an IRS perspective. So you actually have a lot of control on that. I certainly know that there are debt funds out there. And so if your IRA wants to be an equity participant in a fund like that is investing in debt, then you can do that. The loan can be whole or fractional. So certainly there are a lot more opportunities for fractional loans these days than there used to be. And I think that a lot of it is just awareness, because internet platforms and things like that can make you aware of the proposition in front of you. Now, there are some restrictions in terms of who you can loan to in the notes, and that's basically revolves around disqualified persons. So every IRA has a few people, including the account holder, who are considered to be disqualified persons. And so the IRA can't make loans to you, the account holder, your spouse, your parents and grandparents, your kids and grandkids, and your kids and grandkids as spouses. So there are a certain amount of family members that would not be available to participate in some sort of lending arrangement, but everybody else in the world is, pretty much. So again, you have a lot of flexibility in terms of what you choose, and so your preferences and your risk tolerance and all those things really come into play when you're choosing a debt instrument for your IRA. And if you are originating a note, or even if you're buying an existing one, thinking about some of the things that are at play in a note are really, it's an important thing to do, right? So thinking about the amount, what's the interest rate going to be, the length of the term. This is particularly important, I think, with IRAs, because an IRA's lifespan, according to your age, changes a little bit, right? So if you're under 59 and a half and you are not taking distributions, your money can be a little bit more patient. So maybe that loan is structured with a big payoff at the end and not a lot of money at the beginning. However, if you are after 59 and a half and taking distributions, maybe the more important thing is for you to have regular principal and interest payments coming back into your IRA so that you can put yourself on a distribution schedule. Sometimes people will also use that strategy if they're taking required minimum distributions, where you have to take some distributions each year. So a note with that structure, where the payments come in on a regular basis, can be very effective in terms of meeting those obligations. Equity participation, if there's any, thinking about what it is that your IRA, what are the terms of the note when it comes to what do you own, if anything, or is it just a straight note where your interest is just principal and interest payments? And then thinking about, how the structure is, right? So this notes have a lot to do with cash flow and things like that. So when are you making the loan payments out, and when are you receiving the loan payments, and how does that work with the rest of your financial kind of plan and structure? So thinking about all those things ahead of time is always a way to make sure that you're getting into an asset and an investment that will work for you in terms of your overall financial strategy. And I mentioned the fact that often people will roll over retirement funds that they already have. I always try to throw this chart up there. It's from the IRS website, and really it's talking about movement of funds. So a lot of people are unfamiliar with the fact that you may have control over the tax advantaged accounts that you have. Now, if you're still at an employer and they have an active 401k, it's not uncommon for that money to be locked up while you're still employed. But once you're no longer employed there, that money is mobile, so it can be rolled over without tax and without penalty. And a lot of us have had multiple jobs, so you may have an old 401k or other retirement plan somewhere that's mobile and can be redeployed. And the IRA products obviously, have a lot of yeses there, as you can see on the chart. So you have a lot of ability to move those IRA and other tax advantaged account funds into a self-directed IRA at a custodian like Advanta that handles alternatives. And my point here is really that, take an inventory of what you have in tax advantaged accounts, see where you want to deploy it, and then, find out about how to do that, because you may have more control over the investments than you thought you might. And this is going to be my last slide for the time being. I'm going to turn it over to Nathan here in a moment. And really, it's just, a lot of people will say, well, is it hard to establish a self-directed IRA so I can get into these alternatives? And it really is not very difficult, and it also doesn't take a long time, right? So it's a 10 to 15 minute application. It's mostly personal information that opens up your IRA with us. Then you'll put some money into that. Usually it's a transfer from another IRA, a rollover from an old retirement account, or a contribution, or some combination of those things. So you have a new account, you get some money in the cash position, and then you're looking to invest. And you work with your Advanta account manager to establish paperwork appropriate to that investment so that we can document what's going on. And away you go. We can have you invested in as little as a week. It's far more common for it to be a couple of weeks, but it's usually not a couple of months, right? So if you have a strategy that you want to get into, understand that the timetable might be a little bit shorter than you thought of before. Now, since I've kind of laid the framework for IRAs getting into these alternative investments, I'm going to bring Nathan back. And remember, Nathan runs Earnest Investing, and he's been in the lending space for many years. Has some new things going on, and has also kind of put together this presentation to talk to us a little bit about his expertise and the expertise of others in the note investing space. So Nathan, thanks and welcome back to the video world here. So I see that we have your screen up there and are ready to go. So I'm going to turn it over to you.
Okay, excellent. Thank you very much. Well, I appreciate you having me on, Clay, and for Advanta IRA. It's an interesting world because who knew? I think that's a big thing, is that a lot of people didn't even know that you can do all of these kinds of investments inside your IRA. So it's a fantastic vehicle, and notes are very well suited to IRA investing. And so we'll get into it here now about what makes a good IRA investor. So I just want to make sure on my screen, I've got my head right in the middle of the screen. That's not getting in the way. Everyone can see the presentation okay? Or
I think that they can move you around, and I see your slides perfectly. Looks good.
Okay. All right. Just want to make sure I'm not overtaking anything there. Good stuff. So yeah, I'm Nathan Turner. So I started note investing in 2010. Really is when I bought my first non-performing note. So that's usually the date I go with. I started a little earlier than that, but that's usually what I go with, is 2010. So I've been doing this a long time, and I've kind of learned some things over time, and I wanted to share, some nuggets, some wisdom, things that I've picked up over time, and we'll get into it here, see what we can figure out. So I get the title for my presentation obviously comes from this book. I first read this back in university over 20 years ago, and it was a landmark book. I actually was in the university in the 90s, and was not very long after this book came out. So as a class, we actually read this book in one of my business classes, and it was fascinating, and I learned a lot, and it was really a kind of a turning point for me. So I've referred back to it many times, and I've always thought it was such a great book. So I'm borrowing. For fans of the book, I admit I'm very much butchering the content. I'm really just kind of taking the headlines and going from there. So I apologize. I don't mean to offend. I think very highly of this book. One of the very first things that Dr. Covey talks about is having a paradigm shift. And what I went with on this one is surfing versus snowboarding. And the story is, that's me many years ago. I'm still okay. I don't think I could do that anymore, but I'm still pretty good. I very first started snowboarding in high school in 1993, 95, somewhere in that range. And my very first class, my brother and I went up to the hill and we took a lesson. So it was my brother and I and two other guys. These two other guys were both from Australia, and they were surfers. And they came to Canada and they wanted to learn how to snowboard. They figured it was going to be very similar to surfing, and were excited to give it a shot. So we got started, and about halfway through the day, I asked him, I said, so, how does this compare? Is it like surfing? He said, well, mostly. He said the balance is very, very similar, and a lot of the things that we do on a snowboard and a surfboard are very similar. The biggest difference, he said, though, is that on a surfboard, you steer with your front foot, and on a snowboard, you steer with your back foot. And that has stuck with me since, and I still use that when I teach my kids how to snowboard now, and I say that's really how this works. Don't try to point the front of your board. You're trying to shift the back of your board. And anyway, so it was the idea just being that there is a paradigm shift, and you have to be able to accept that this is different. And what I'm talking about here is this is real estate related, but this is not real estate, and you've got to make sure that that's clear, because it's a very different thing. It's actually much more closely related to finance than it is to real estate. Real estate just happens to be the collateral behind the loan, behind the note that we're buying. So that's the very, very first thing. The next thing I would say is under the title of being proactive, figuring out what it is that you want to do. There are so many different ways that you can do this. It wasn't until, like I say, I was in note investing since 2009, 2010, and it wasn't until about 2015 that I met with a friend, and I had done all kinds of different things in notes. I'd created notes, I had brokered notes, I had worked for a company selling notes, and done all kinds of different things. But it just wasn't, it wasn't quite right. I liked the business, but I didn't love what I was doing at the time. And so I sat down with a friend and was kind of going over all this stuff. And he says, so what do you want to do? And I thought, oh my gosh, I haven't thought about that for so long. And that was kind of the birth of the Canadian Note Guy. And that was my old logo. That's kind of how I got started in kind of really doing it the way that I'm doing it now. And it took some time and just thought through exactly what is it that I want to do. How do I want to approach this business? And so that's what I would say is just figure out how is it that you want to approach this business. There are so many different ways that you can do it. A lot of them are right. There are very few wrong answers in how to approach notes, but just figure out what it is that you want to do. If you don't know anything about notes and if you're brand new to it, then please get some education. Again, this is not real estate, and the rules are different, and you have to know what you're doing. You could get yourself into all kinds of trouble. So get some kind of education. I don't teach. I can refer you to some people that teach and do a very good job of it, but make sure you've got some level of education of what you're getting into. And then get to know others. Get to know other players in the game, the sellers, the vendors, the other investors. You'll find that so many people in the note business are very, very free with their information. About the only thing that we won't tell you is where we're buying our notes. And that's kind of the closely guarded secret, which again comes back to networking. And so being proactive about getting out there and getting, letting other people know what you're after so that you can get to it. So like my very first note deal was a package of 3 notes that I bought for $10,000, and that was back in 2010. So that's why I used that date. So it's my first non-performing purchase. Today I actually run a fund. So I just opened up a note fund at the end of last year. I'm raising capital for that, and that has become earnest investing. So that's an exciting change for us. And then the most latest and greatest, just 2 weeks ago, I was down in Florida, and at the DME, Diversified Mortgage Expo, I actually bought the company. So I am now the host, the owner of the DME conference, and excited to run that in the future and just teach others about this incredible business and how much fun it is and how you can use your IRA to get involved. One of the big things that I take from Covey's book is beginning with the end in mind. And like I said before, there's so many different ways to approach this, including exit strategy. What is it that you want to do, start to finish? And I've got this chart we'll look at a little bit more in detail in a couple of slides here, but just to give you an idea, you can start here and end up all kinds of different ways and all different kinds of methods of exiting out of a note. So what's your preference? And not to say that it's always going to go that way, but what's your preference and what is it that you're looking to do? Do you want just performing notes? Do you want re-performing notes? Do you want some of the non-performers? And then if you get a non-performer, then which direction do you want to take that? So making sure you understand that there are multiple exit strategies and what's your preference and figuring that out. Do you want first lien, second lien? Are you looking for specific geographical areas? Do you want in one city only or one state only, or what states do you not want to get into, and just figuring that kind of thing out. What size of note are you talking about? Do you want something balances over 250,000? Do you want $500,000 notes, or do you want the little $100,000 notes? And are you going to buy and hold, or are you going to flip? And what kind of business organization are you going to set up? Are you going to set this up as a fund? Are you going to just do it in your IRA and buy a couple at a time? But what is it that you're going to be taking down? So this is my preference, and again, this is my preference, not right or wrong, just what I like, what I've kind of gravitated to. I like property values, notes on properties where the value is between 50 and 150,000. The unpaid balance is usually right around in there. Depending, back in the day, there were always, no equity. Today, there's much more equity, but just again, that range is kind of my preference. I like fast foreclosures. So what I mean by that is about a year or less. So states like New York, states like New Jersey, a lot of those New England states, they're tough. So I tend to stay away from those. I like first lien mortgages and contracts for deed. Anything first lien, reverse mortgages, that kind of thing. I'm a big fan of that first lien position, and I'll take on the hairy stuff as well. I don't have a preference in vacancy. If somebody lives in the house, great. If we can get them reperforming, fantastic. If there's somebody not living in the house, that's fine. If I need to go through a foreclosure to take back the property, that's fine too. Equity, no equity, I don't really care. And are you going to do this as a keeping the performers, or are you going to rehab them and then resell them as performers? Are you going to sell or finance the properties you take back, or are you just going to sell them on the open market? There's lots of different decisions to make up. These are mine. I keep the performers and then I rehab the NPLs, either get them performing and keep them, or take back the property and then sell the property. Again, ideally, I can get that as a seller finance deal and create another note and hang on to that. So there's lots of things to consider, but that's the part about begin with the end in mind. Figure out what it is that you'd like to do and work from there. And then, of course, the fund organization. I've chosen that as my preferred method, and I enjoy that. And that's a different discussion of why. But putting first things first, I'll try to get through this so we get some time for some questions. So I apologize if I'm going kind of fast, but stick with me. Due diligence. Anytime you're buying a note, there's a load of due diligence to do. Anytime you're buying anything, I hope you're doing some due diligence. When we're talking about notes, we're talking about value and title. In the first position, those are really the two most important things. So when I'm talking about value, I'm talking about I get, anytime I buy any note, before I do any kind of purchase, there's all kinds of free due diligence I do. And then I always get a BPO. I'll get a local realtor out there to lay eyes on the property, give me their opinion of what it's worth, and we'll go from there. And then title is another one, and I'm always making sure I know what the title is. I put this one up because it's kind of fun. If you can read that, this is one that I passed on, but it's this line right here, where one of the liens attached to this was US of America. And I went, oh, that's not good, for $167,000 on a, like it was like a $75,000 property. And that was not good. I found out I'd never seen that before. I had no idea what that meant. I found out that it had to do with the Department of Justice. So not something I want to get involved in, and I was able to pass. But I always run the title because you never know what's out there. So this is the free due diligence. I'll give you a quick rundown of how I do that. I will get a list of notes, anywhere from 10 to 200. And if I've got that bigger list, I've got to be able to narrow that down. Even with the smaller one, how do I choose from those 10? Am I going to take all of them, or just one or two or five? But I've got to choose from that list at some point. So I'll do things like I weed out states that I don't like. I'll look at online values and taxes. I'm looking at a BPO after I've done all of that and I'm satisfied and I'm ready to make a bid. After I make a bid, then I'll get a BPO. So up until I make that bid, everything I've done before that is free. After that, then I do some paid due diligence, that BPO and that title search, and you do not want to skip a step. Trust me, I know. Next one that Covey talks about, he talks about thinking win-win. This has everything to do with just mutual benefit. And this is a great chapter in that book because he really talks about, high courage and high consideration. And that's really the mutual benefit portion of it. And that's really, really key. And that's a lesson that I've taken to apply into everything I'm doing. So I'm talking about, like, when I'm speaking with the borrower, if the borrower is making a very low payment, that I'm like, okay, if I'm making a consolidation on that, like if I'm kind of basing myself to, well, fine, that's not really a win for me. And vice versa, if it's so high and the borrower's like, well, I hope so, that's not really good for that borrower either. So we're really, really coming down to what is exactly the win-win, and taking some time to figure out what that is. Doing the same thing with other sellers, people that are selling the note. Price obviously is a big consideration, but what's surrounding that consideration? Let's say maybe a consideration is my offer is a little bit lower than somebody else's, but I can close on that sale this week. Is that worth it? And is it somebody I've done business with before? Maybe that enters into that win-win conversation, and that becomes part of the deal. With your investors, again, you want to make sure that it makes sense on both sides, and making sure those expectations are clear. The story was when my first purchase, I did a deed in lieu, a DIL, and I approached the lady and I said, so I'm not here to collect any money. I just want your property, and I'm willing to wipe out the loan if you just sign it over. And she was in tears, and she's like, really, are you serious? You know, don't joke. And I'm like, no, really, that's all I want. And it was a huge lesson to me that I was solving somebody's problem, even in that situation. I didn't think I was. I was just after a property. But in going through the steps and figuring that out, I realized how much this business is based on win-win solutions. And I love that about this business, of just thinking it through and making sure that you talk with the people involved, anybody who's involved, and figure out what's mutually beneficial. Another point that Mr. Covey brings out is seek first to understand, then to be understood. And we're talking about different points of view, but we can be looking at the same picture. And I know on the internet there's all kinds of optical illusions these days. And you may have seen this one already, but let's have a look. So the very first thing, what is it you see? Some of you are saying, well, I see the old woman, and she's got her chin down and she's kind of looking down to the side. And then other people are saying, no, that's the young woman, and she's some rich lady and she's looking over her shoulder, kind of not giving you the time of day. And the answer is yes, you're both correct, but it might take a minute for you to see both sides, to see both of those pictures. And that's a big point. So you're looking at different points of view, but the same picture. So when you're talking to your borrower, being able to put yourself in their shoes and saying, okay, so you're coming from this angle. Okay, so now that I understand that background, and now that I have that information, now we can have a different kind of a conversation, because I understand where you're coming from, and vice versa. They have to understand where I'm coming from. I own this mortgage. Obviously, we can't have you living there for free. A line that I learned from a book years ago was, the only thing we can't do is nothing. And I love that line. And I think that is such a brilliant line to say. So, you know, I understand there are all kinds of problems. I understand, you know, things have happened. Great. So the only thing we can't do is nothing. Therefore, what are we going to do? And coming up with that. And again, going back to the investor expectations, and just making sure that on the investor side, that we understand what the investor was expecting in the beginning and how that's going to look in the end, and making sure that we can come together on those points. Synergize was another one of Dr. Covey's points. He says, open your mind to different possibilities. So we're going to look at different multiple exit strategies. And this is that chart that I brought up earlier. Here's a better view for you. I'm not going to spend a ton of time on it, but I just wanted to illustrate again. You know, let's say you've got one as occupied. Maybe the answer is no. The borrower's already taken off and the house is vacant. So can you locate the borrower? If the answer is yes, maybe you can work out a deed in lieu of foreclosure or a short sale. I didn't even put short sale on here. Oh yeah, I did. It goes up here over to the short sale over there. So that's one option. There's two options out of one situation. If the answer is no, you can foreclose. After you foreclose, then you've got all these options open to you. And just kind of following that through to see how you can make the best of the situation, whatever that situation might be. And sometimes it takes others to collaborate with to come up with these answers. So I'm talking about other vendors, other note investors, how you can come together and figure out what it is that you need to do to make this a winning situation. Let me give you a couple of examples. 6803 Backstrom in Texas. Great note. The people were paying, they're making their payments regularly. We did have some communication back and forth, and that was the challenge. I don't speak Spanish, and they only spoke Spanish. So that was tough. So therefore, I had a problem, they had a problem, we couldn't understand each other. I've sold this note rather than hang on to this one. I sold this to somebody else who speaks Spanish, just to make that a lot easier, so that they, for both sides, then that can make a much easier solution. McMillan Street in Indiana. This is one where it was kind of a complicated situation. We got to the very end of being able to sell the property. I took the property back and selling the property. There was all kinds of family drama that was really getting in the way here. So much so that even though I thought, and I knew, by the way, that there was no reason that there was any kind of title issue on this, the title company we were using was making a big deal of it and said, no, there's going to be this kind of issue coming up. And I'm like, no, there's not. Like, legally speaking, I'm not even just saying like it would never happen. No, legally speaking, we've covered all the bases, but they were being adamant that that was a problem. And so I'm like, well, how am I going to solve this problem? So I called my attorney and said, so I'm right? And he said, yes, you're right. And if they're not going to work with you, just call a different title company. Oh, of course. But I was so wrapped up in it, and I was so concerned about proving my point, that it never occurred to me to call somebody else. And it took a vendor, my attorney, to point that out, and I went, oh yeah, of course. And so we did, and they closed the deal, and there was no problem, as I suspected. One more here in Corinne in Mississippi. This is one I had. I took property back. It was already in foreclosure when I bought it. I had it up there, and it just wasn't selling. It wasn't selling. And my realtor was saying, well, the realtor thing, well, let's just lower the price. And I said, I just don't want to do that. I think it's really worth what we think it's worth. We just need the right buyer. It's in a smaller town. And so lo and behold, we get approached by somebody. I said, well, why don't we, instead of lowering the price, let's offer seller financing. Sure enough, we had somebody come over. We had listed it for $100,000. Somebody came in with a $20,000 down payment. I only actually wanted 10. So this was great. And the way the numbers worked out, that $20,000 cash down payment really took care of me very well. And so it made it worthwhile for me to do a seller finance deal. And I didn't have to take a discount. So I ended up with a paying note now, and she's been paying the last 6 or 8 months on a $20,000 down payment instead of taking the discount and making less money. So that one came from me. That was my suggestion to my vendor, and that's how we solved that problem. But just coming together and talking about how are we going to solve this problem, that's an important thing. Dr. Covey talks about sharpening the saw, and this is just about like looking over the fine details of your business and treating it like a business. And one of the ones that I love about this one is setting your own hours. So I'm in my home office. I love my office, and I love being at home. I love working from home. I keep my fund and everything that I do small on purpose so that I don't have to have an office outside the home. I love this lifestyle. One of the challenges we had, especially when the kids were younger, is coming to see dad, and then in the evenings I was answering calls and doing emails and things, and it was taking over my life. And so it was a chance for me to sit down, and my wife and I chatted, and we said, no, I'm in charge here. This is my business. The business doesn't run me, I run the business. And so we set specific hours. So we went 9 to 5, Monday to Friday, within reason. Obviously sometimes there's exceptions to that, but by and large, we set regular work hours so that those are the work hours. And outside of that, nothing's going to happen at 9 o'clock at night that can't be solved at 9 o'clock in the morning. That's my opinion. And then working on your business instead of in it, and just taking some time out. And my wife and I do this from time to time, where we just take some time off and just say, okay, so these are the processes we have in place right now. Is there a different way we could do that? Is there a better way we could do that? A more efficient way of doing that? And we'll take some time and actually analyze what we're doing and how we're doing it, and see if we can't make it better. And then conferences. I'm a huge fan of conferences in general. So I said earlier that note people won't talk about where they're buying their notes from. That's the secret sauce. You go to conferences and network like crazy. And that's what I've been doing since my first note conferences in 2009. And so I've been talking to people, and people in the note world know who I am. I know who they are. That's how deals get done, because we know each other. And so that there's no substitute in my mind for just going to conferences and networking and talking to people. One last point that Dr. Covey brought up in his book was talking about inside out. And this is where he and his wife went on some kind of tropical vacation, but not a vacation. They were there for like a year or something like that, and just really got in and through everything and just worked everything out inside out. Like I say, one of the kind of the realizations for me at the beginning, I was all about trying to get to the property. And it took a couple of years, honestly, until I went, why am I trying to get the property? The note is really where it's at. And that's all I really want. And so that's where I kind of came up with this, is like, this is real estate related, but it's not real estate. So make sure you understand that that's the difference. And then just taking some time to think it through and say, okay, so if I did this, then that's how that would work out. And really taking some time to think through exactly what you want to do, and knowing your numbers. When we were setting up our fund, we went through numbers and numbers and numbers and numbers, making sure that when we set up that fund, that we set it up in a way that we knew we could take care of our investors if we paid out this much, and still be taking care of ourselves, and went through it like crazy and made sure that we knew exactly what we were getting into and how we could solve problems and meet expectations and all that kind of thing. So how do you get started in this? Again, it's real estate related. It's not real estate. Get some kind of education. Make sure you know what you're doing. If you don't want to do this on your own, it sounds really great, and it is really great, and there's lots of different things, and there's a ton to learn. Yep, there is. What if you just want to invest passively? Absolutely. Just like Clay was saying at the beginning of the call, you can get involved passively. You can buy a note into a note fund and have that be the way that you invest in notes, and get involved that way. So that's just food for thought. If it sounds great, but you don't have the time or the inclination, invest passively. That's the way to go. So that is my presentation. That's my contact information. I think Clay's got another slide with that on there, but I wanted to leave enough time, so I apologize I went through that fairly quickly, but I wanted to leave some time for some questions. So please ask your questions, and let me know what you're thinking, and we'll see if we can't answer any of those questions right now.
I was muted there. All right, thanks, Nathan. I appreciate that. That was it was really interesting how you distilled your experience in the notes. I was kind of curious as to what prompted you to start. I mean, I understand your 2010 date of the first kind of package, but what got you interested in that asset class to begin with?
You know, I kind of fell into it. It was kind of by accident, where I had been mandated by another company that had bought a bunch of properties just before the crash. And the crash happened, and then the value of those properties went way down, and they had no idea what they were doing. So the mandate that I got, me and my old partner said, okay, go do what you can. So we started doing seller financing. So that was kind of my introduction into notes in 2008 and 9, and really wasn't doing it correctly. And it wasn't until I started doing some research on how we could, the idea was create a note and then resell it. I didn't even know it was called a note, but just in the process of doing some research, figured out that's what that was, and then learned how to do it better and started going to note conferences, and just kind of blossomed from there.
Right. It's that evolution is always interesting to me, because I think a lot of us have found expertises in things that we just kind of got steered into. So
yeah.
So everybody in the audience, this is a great time to go ahead and type in questions. Please do so when you get a minute, and we're going to go up until 1 o'clock here, and answer questions if you have them. Really appreciate you attending today, and hopefully this has been an interesting and also informative presentation about things that you can think about if you want to incorporate note investing in your IRA or just your personal funds as well. So Nathan, I think I'm going to start asking some questions from the audience if you're ready. Do we need to be an accredited investor to invest in your fund?
Excellent question. Yes, this is a Regulation D 506C fund. and part of that qualification to invest is you do have to be accredited.
Okay. And one of the questions says, please share a typical term sheet you would show in prospecting for borrowers.
Oh, prospecting for borrowers?
Mm-hmm.
That's interesting. So I know there are some people that will send out mailers and things like that, looking for people to just sell their loan. I'm not sure if that's what they're referring to.
Well, those of us who are less experienced in notes, so if you're kind of looking for borrowers, what do you send out? How do you indicate that you have money and that you're in that space and are a potential lender?
For me, I start from the perspective of I'm buying an already existing loan most of the time. So that goes back to the conferences where I'll go to a conference, and I have been going to conferences for years, and I'll network and see who's selling some of these loans. When I'm looking, if in the situation where I'm taking back the property and then selling it off at that point I am looking for borrowers. Usually it's done through a realtor, and I'll just say that we're offering seller financing. And then, so maybe at the root of the question here, okay, so what I typically do when I'm selling on terms like that, my ideal, my best case scenario is that I'm going to get a 10% down payment, I'm going to charge 10% interest rate, and I'm going to amortize that over 10 years. So ideally I can do that 10-10-10. Of course, that's flexible. I'm not a bank, so I've got all kinds of flexibility in that, and I can change that. Maybe I amortize it over 20 years or even 30 years if we need to. Maybe the interest rate is 8 or 9%, but ideally that's what I'm shooting for, is that 10-10-10.
Okay. Let's see. What software do you use to run title?
To run title, great question. So I don't run title myself, but I do hire that out. That's one of my vendors. On the screen there, the one I shared was Pro Title USA. They're very well known in the space, and a lot of people use them. They're really great. There are a few others out there. That's the one that I usually use. I've used a couple on occasion, but normally it's Pro Title.
Okay. Are there note conferences that you recommend that you like?
There are. The DME is a great one, and I'm putting that one on. That's going to be in Nashville next spring. It'll be March or April. So we just had it here a couple weeks ago. So more details coming out on that one as soon as we know. We haven't picked a date yet. Another one that's coming up in Las Vegas in May is called Paper Source. That's a great conference. And it's not just about mortgage notes, it's about all kinds of structured payments. So anything, there's a guy that I heard back in 2009 at my first conference where he talks about buying lottery winnings, other people's lottery winnings or something like that, structured settlements, and it's a fascinating topic, and I've always thought it was really cool. All kinds of things like that. So it's not necessarily just mortgage notes, but that's a really good one. The other one that I would say that's coming up in November is Note Expo, and that's typically in Dallas in November, early November, I think.
Okay. This is a great question. I don't know the answer because we're not a 1031 intermediary, and you may or may not know, but the question is, can a note be used as part of a 1031 exchange? Do you have any knowledge of that, Nathan?
I'm not positive. I believe you can do it from a note to a note, but I don't think you could do it from like a property to a note.
The like kind exchange. Yeah.
Exactly. Yeah. So that requires a little bit more homework, but I think that's how that goes. Don't quote me.
Yeah, and I'll just own the fact, we're a custodian for these tax advantage accounts, but we are not a qualified intermediary for 1031. So my expertise there is not a good it's not a good place to ask the question.
Yeah.
So it sounds like the conferences are one way that you get some education, but the question is from the audience is, if you're a new person, what are kind of the first steps other than known gurus that they would take to start educating themselves and get that knowledge base?
There are, it's great. When I first got started, there were no books. There was one book, and it was called Invest in Debt by Jimmy Napier. It has since been, it was out of publication for a long time, and then I just heard a couple weeks ago that they're starting to print that one again. And that's kind of the godfather of notes. And it was written back in like the 80s or 70s even. Really good principles. The numbers are obviously way off. He's using numbers from back then, but
Right.
the principles are there and they're solid. There are a number of other books out there. Oh goodness, if you just look on Amazon, note investing, and search that, you'll find several. And I know most of them. I've read most of them, and I know a lot of the authors, and I don't know that there are any that I would not recommend. They're all really good.
So I'm going to ask you a question, because I was talking about this with some of the other folks that we network with the other day, and has the note investing kind of asset class or space changed significantly over the last couple of years? Have you needed to adapt and try new techniques and adjust your numbers and that kind of thing, or has it been more stable than maybe some of the other things that have maybe gone up and down? I'm kind of curious about that asset class. What's the state of that?
Yeah, great question. So, like I mentioned, my very first note purchase, it was a package of 3 notes that I got for $10,000. So that was a steal. Even back then, that was a pretty good deal. And you can't get that today. That's not the kind of pricing that you could ever find anywhere anymore. So the pricing has definitely gone up. Gone up enough that education is that much more important. When I first started, there were not a lot of educational platforms out there. There were not a lot of teachers about notes, and so a lot of it was just trial and error, and there was a lot of error. But the prices were cheap enough that usually, the errors were okay, and we still made it out okay. Today, to make those same errors, you get in a lot of trouble. You lose a bunch of money, and that's no fun for anybody. So that education part is really important. But again, to go back and answer your question, yes, the tactics and things not so much, but certainly the pricing, and so you just got to be careful about making sure you do that due diligence really well and buy right.
Got it. So, and this may be our last question so that we can wrap up on time and get everybody on about their day. But the question is about, you had talked about certain states that you preferred and some that you didn't really want to get into. How did you start to, I'm going to paraphrase the question. So how did you start to narrow down what geographies you liked and what you didn't, and what were those factors?
Sure. So the main thing for me, so there are a couple of things, but the main thing is I'm looking at foreclosure timelines. So kind of the worst case scenario, I guess the worst case scenario really is foreclosure. So if I buy a note and they're not paying and we're not able to work something out, or they've just disappeared and we can't contact the borrower, then I'm going to have to foreclose. That's kind of my last resort, and take back the property. So knowing that that's a good possibility, there's a good chance that that's going to be in the future of this note. That foreclosure portion is one that we look at pretty closely. So for example, Texas, if you hit all of the dates just right, you can actually foreclose in 2 months flat, which is fantastic. I've never done it that fast, just because, like I said, they only do a foreclosure sale once a month at the beginning of the month. So typically it takes more like 3 or 4. Just in practice, that's how that works. But still, that's pretty fast. A state like New York, especially if you're in the boroughs, but even upstate New York, it's easily, you're taking 2.5, 3 years to get a foreclosure done. And so that's a long time to have your money tied up and to be carrying that and paying property taxes, and paying, if it's vacant, then you're having to pay to keep up the property and things like that, so it doesn't fall over. So that's a big deal. And New York, so that's long. And then you've just got difficult states. I've had one in Maine and one in Connecticut, and they've just got really weird foreclosure laws. In Maine, for example, one of the things that you have is if you're going to take that loan to foreclosure, for every time that the mortgage has changed hands, you have to have a representative of each company that has owned that loan over the last however long. So you could have, anywhere from 5 to 20 different times that that loan has changed hands, and somebody from every one of those companies has to be present at the foreclosure, which is ridiculous. Like it's not even possible really. And so there is a workaround, but it's it's just difficult. So that's another biggie that I'll stay away from those kind of states. And then licensing is the other one. So like Georgia, for example, they require license if you own. There's debates out there, and I won't try to get it exactly right, but I've heard anywhere from 1 note to 3 notes, and the jury's out, and it depends on which attorney you're talking to. So you got to just make sure that you're licensed, or just don't buy in that state. So as a rule, I don't buy anything in Georgia just because I don't want to deal with the licensing. I don't want to pay the fine for pay the whatever tax or whatever the fee for getting the license, and then I certainly don't want to pay the fines for not being licensed and getting called out on it.
I guess it's another, endorsement or reason to get experience or access experience, just because there are things that it sounds like, better to know ahead of time.
Exactly. Yeah.
All right, well, Nathan, we're going to go ahead and wrap up. Anybody who's typing in a question, if it didn't get answered here, I will certainly forward that to Nathan if it's for Nathan, and he can get back to you.
Yeah.
I want to thank you again for your time and for your letting us use your contact information. You and I chatted before we started. We're both happy to be ongoing resources for you guys. Those of you who are watching this presentation, so please do feel free to reach out to us with questions or run scenarios past us and things like that.
Yeah.
Nathan, any last kind of remarks as we close up?
I think that's it. I think that's it's a big world and there's a lot to learn, and don't let that scare you, but make sure you know what you're in for. And if that means it's a cool business, but I just don't want to do it, great. Then either with me or somebody else, go ahead and invest with somebody else. But just follow the rules. Everyone will be fine.
Very good. And for me, I'll just say, if you're considering self-directed IRA investing, there are some things to know. So I'm happy to be your ongoing resource. We work at whatever time frame you're looking at is fine with us. So please do feel free to get the information just so you have the tool in the bag, so to speak. Thanks a lot for joining us today, and hope everybody is happy and safe. And we will see you on the next one. Bye for now.
Thank you so much.